Good morning, everybody.
Good morning.
Yeah. You know how sometimes real life just gets in the way of things? The first 2 weeks in January got in the way of our presentation a little bit, so I owe it to you guys to touch on that a little bit, so I revised a little bit of the presentation at the beginning to cover some of the things and what we're going to do about it. We'll talk about that a little bit, and then we'll get into the good stuff, all right? Why you guys came here today, to be rationally optimistic. So what's going on? You know, first 2 weeks in January, we see in the headlines, right? Worst start ever for U.S. markets. Right on the front page of every newspaper in the country. And that's true. Does that tell us anything about the future? No. Could keep going down? Sure. But it could start going back up again. You know, this last week, we had an up week. Who knows what next week is going to be, but I'm going to show you why you can be rationally optimistic later and stick with it. And of course, this is about stocks, right? We don't own 100% stocks in our portfolio, and then you get stuff like this. When the markets are way down, you get these advertisements, right? Dow to drop 80% in 2016, some economist says. Now, I showed you in past classes how good the economists are about forecasting the future. How good are they? They're terrible. They don't know. But if you understand that these guys that put this out, and I collected all kinds of information, past and present, on this guy, he has no clue what's going on. It's his life, it's his life's work to scare people into sending him money. That's what it is. He has no idea what's going to happen. Then we see stuff like this. Bear sinks Russell 2000. Well, Russell 2000 is small caps. They're already in bear market territory. George Soros, communist George Soros, it's 2008 all over again, right? And then that leads to confusion. Should I sell everything or brace for a rally? Of course, that was on an up day. And then on another down day, more confusion. Dow plunges 300, but the best 9 stocks to own now. And don't pay $99, get them here for free. Right? Crazy. And here's more confusion for investors. Is it going to be an oil boom or oil bust or bankruptcies? It's crazy what's happening to oil right now, right? It's just going down and down and down and down. Now, that's going to really help us out as us consumers because, you know, products are going to be cheaper, oil and gas is going to be cheaper. So it's going to help us out in the long run, but it's going to hurt a lot of these oil companies, which are part of the investments that we're in. And then more confusion. Goldman Sachs sees a good year ahead. They see 11% upside for this year. So who do you believe? Do these guys know? They don't know either. They really don't. But this is nothing new. This is all the downturns since the March 2009 low. There were 19 downturns of 5% or greater, 8 down of 9% or greater, 5 down or 10% or greater, and 2 down to 17% or greater. There was a 17% decline in 2010. There was a 21% decline in 2011. Do you guys remember that? Probably not, right? So it's nothing new. What happened after every one of these declines? Yeah, higher highs and higher lows. That's typical market pattern for decades. Now sometimes it takes a while to work it out, and that's the hard part about investing, is the patience required for it to work out. My account is down. Is my portfolio broken? I need to do something. What we're doing is disciplined rebalancing on highs and lows. So why rebalance? It's a buy low, sell high discipline. It's risk management. It keeps your risk consistent, your portfolio consistent over time, and it eliminates the need to forecast and predict. We do it on a disciplined, systematic basis. We don't rebalance because we think the market's going to keep going down or the market's going to go up. We do it on a quarterly basis. We look at each account that needs to be rebalanced. Some accounts don't need to be every quarter. Some accounts do, especially when you have market volatility. So market movements provide the opportunities to buy asset classes when they're underweighted and undervalued, to sell securities when they're overweighted and overvalued. And it's not extreme. If you look at your recent rebalances that we just did this week, it's just buying a little bit and selling a little bit. And all those headlines were talking about the stock market, right? What's happened to the bond market this month? Bonds are up. Now, obviously, they don't have the volatility of stocks, and they're not up that much, but they help offset the volatility. So, I'm going to ask you a question here in a second, and I want you to be brutally honest with yourself and only raise your hand if you can absolutely 100% answer yes to this question, okay? How many of you feel like adding to your portfolios with the markets down over the last year and a half? Okay? Yeah, I'm impressed. There's a few, okay? But if it goes down another 10% or 15%, it might be this, okay? Okay. Now, I'm going to ask you another question. Looking back in hindsight, back to the financial crisis of 2008 and 2009, a year and a half of just terrible headline after terrible headline. How many would have, looking back in hindsight, would have liked to added shares every quarter during that 18-month period? Okay, it's so easy in hindsight. The problem when we're going through it is we can't see the future. None of these guys on TV can see it either. That's what makes it difficult. We don't know what's going to happen. Here's what I can tell you. When you're in it, it feels like it will never, ever end, because we go through it day after day after day. It will end. Bad times never last. You see this in the prospectuses and all the disclosures in the magazines and all that stuff. What they should be telling us is things will change for reasons unknown to us at the present time. That's what we tell people. And if you know that, and that's good or bad too, right? Good things can happen too. And performance will be different every single year. So let's take you back to May 2015. Things were looking pretty good last year in May. Our portfolios were doing great. We were making some really good returns. All the world was up. Even Russia plus 42%, China plus 20, and Japan plus 16. You know, U.S. was down here, but it was still in positive territory. And just 7 months later, look what happened. Only Japan and Russia were in positive territory. Now remember, Russia finished break even, but they were at plus 42%. So what kind of a decline was that, right? They're an oil-driven economy. That's why. So now you have all these negatives in just a 7-month period. And that's what we had to go through during the last 7 months. And then all of a sudden, the last 2 weeks, or the first 2 weeks in January, it got worse, just like this. S&P 500, in 2 weeks, minus 8%, right there. Bam. What about the rest of 2016? Yeah, who knows? The returns will continue to change in unpredictable ways. But that's why we don't chase performance. When the S&P 500 is up 20, 25%, 30%, and those periods will come, they will happen when we least expect them, we don't chase it. And that's why we own high-quality fixed income in the portfolios. I can say with confidence that none of you guys have 100% stocks in your portfolios. Raise your hand if you have 100% stocks in your portfolios. Okay? Neither do I. You know, it'd be foolish. Plus, most of you have checking accounts, savings accounts, money markets. You might have a CD, you might have some fixed annuities, you might have some index annuities, you might have some rental real estate. All of that in your overall net worth also reduces your overall net worth volatility. So it's important to keep perspective. So how should we deal with uncertainty? To reduce turbulence, we use the high-quality short-term fixed income. And now you know why we have the fixed income in the portfolio, because we can have the downside volatility. When things are great, people are wondering, why do we have that in there, John? It's only making 1.5% or whatever it is. This is why. This is 100% stocks. Look at that volatility. People can't take that. 75%, 50%, 25% stocks, and that's the volatility. I would much rather have you in something like this that you can stick with than get into this and then panic right here and cause yourself permanent losses. Don't be tempted to take on more volatility than you can handle. In order to do that, you have to know your risk and your volatility, and we're going to spend a lot of time in that next class. Know your risk so you know what to expect. Which roller coaster are you on? But you have to know these things so you don't get caught off guard. In any 12-month period, it's highly likely that my portfolio, whatever it is for you, will make a return within this range, and you can't be surprised if it happens. Now, obviously, good returns can happen from time to time too. Pick a portfolio level that you can live with no matter what comes, and say no to taking on more risk and volatility than you can handle. So I own these diversified portfolios. Scott owns them. Kara owns them. You know, I'm going to stay prudent. I'm going to stay diversified worldwide. I'm going to stay diversified in many asset classes, not just stocks. Stay disciplined and patient. Rebalance small amounts out of hot asset classes and funds. Rebalance small amounts into down asset classes and funds. And keep my risk consistent. And above all, I'm going to avoid forecasting, predicting, guessing, and market timing. Time reduces risk. So here's the minimum holding periods. You know, for a conservative allocation, it'd be 3+ years. Balance, 5. Long-term growth, 6. Aggressive, 10 years. Better yet, for a lifetime and beyond. I see no reason for myself that I'm ever going to sell my broadly diversified balanced portfolio. I'm in about the 50-50, 60-40 range throughout my lifetime. I'll have some savings accounts, I'll have a little real estate, stuff like that, but I see no reason to ever sell it during my lifetime, no matter what happens in the economy. Historically, negative periods of 5 years or more are shockingly low. I've covered that in other classes on the rolling period returns of 5 years or longer, and we'll cover that in the next class too. So an investor could wake up, sleep through the drama for over that 5 years or several years, and wake up 5 or 10 years later. Would they behave differently? Most of them would, yeah. Now, for an investor with a short-term mindset, it's just a matter of time where some investment professional, and I put that in quotes, right, will tell you anything you want to hear. Say, yeah, I can do all this great stuff for you, and I can make all these great returns with no risk, and I'll protect you from the downside losses. So Scott and I, we don't give you wish fulfillment or empty promises, or we don't prey on false hopes like some of these guys do, especially the doom and gloomers that are out there. Things will change for reasons unknown to us at the present time, and performance will be different every year. So here's the to-do list. We're going to stay diversified, all of us, right? Scott and I, we're not going to market time. We're not going to panic. We're not going to move your portfolio to cash. Ultimately, it's your choice if you wanted to do that. We could do that, but we're not going to do that for you. We're not going to cause you the permanent losses that it will lead to. We're going to ignore the media hype and horror. We're going to coach and educate you. That's why we do these classes. That's why we send out the videos each and every week, so you're constantly up on what's going on. We're going to stay disciplined, stay diversified, and rebalance. Investors forget when panic strikes, when things happen, under pressure. That's why education, consistent education, is so important. Zig Ziglar just passed away not too long ago. People often say that motivation doesn't last. Well, neither does bathing, right? That's why we recommend it daily. That's why it's so important to be educated about your portfolios. Pat and Vern, you talked to me about your daughter. They don't know about the risk in their portfolios. They don't know about what they're doing, and they're speculating and gambling. And if they had this education, they'd have a different type of mindset. So it's important that they have that consistent education. Your to-do list: turn off the media hype, focus on a lifetime and beyond, attend classes. I'm preaching to the choir here, right? You guys are here today. It's awesome. Watch the coaching videos and continue to learn. If you have questions, call us. Okay, call us for sure. Trust in the process. Pick a portfolio you can truly live with no matter what comes, and ask the right questions. Then enjoy your life.